Good day. My name is Robert Mulroney, Senior Investment Advisor with Mindset Wealth, IA Private Wealth. Welcome to our 16th annual Look Ahead Conference, timestamp for April 25th, 2023. I have with me, I'm in the boardroom in downtown Vancouver with Mr. Rudy Chung, and Russ Waggle is in beautiful Comox Valley. And we have Adil Marouk in Montreal. And Adil is joining us today, extra special guest, as Barry Ritholtz would say, senior strategist and director of asset allocation with IA Investment Management. So thank you, Adil, for being here.
Well, thank you for having me. Very happy to be here.
We like to do these, again, it's the 16th annual. We've been up at Crown Isle. It's a little later in the year, but there's a lot of things going on. So we love to do these for clients, to educate and motivate. I personally like it as a timestamp. You go back to our website, you can see some of the things we did during the pandemic. We are really living in interesting times, and it's a fascinating business. All of us have been in the business it's our 28th year here. Yeah, so fabulous. I'm going to turn it over to Adil, and then we're going to come back and do some questions. But without further ado, let's go to Adil.
Thank you. Well, as people say, may you live in interesting times, and these are definitely interesting times in the economy and in financial markets. So let me start where it all began. We had the pandemic, inflation went through the roof, completely out of control, and so central banks or monetary authorities had to kind of react to bring that inflation back down to something that we were more familiar with, which is around the 2% range for Canada and the United States. So they implemented some conventional monetary policy, which is raising rates, and they did some other kind of, monetary plumbing that we're not going to go into the details of. So what happened is monetary policy propagates through the economy in between 6 to 24 months. So when the central bank, the Bank of Canada, raises its rates by 25 basis points, as we've seen it do several times over the past year, well, it takes a little bit of time before we actually feel the effects of that rate hike. And now, since the rates started increasing a little over a year ago, we are beginning to feel that kind of delayed effect of monetary policy. Rates have gone up significantly, be it regular loans, sometimes on credit cards, on mortgages. We have seen a slowdown in growth, so economic activity is kind of slowing down, slowly but surely. The labor market has been remarkably resilient, and I'm sure that in your own personal experiences, you've seen that, whether you're trying to hire somebody or just to give you an example in my personal life, I have my favorite bakery across the street from where I live, and now it's closed 2 days a week because they cannot find staff to help them over there. And that's like the real effect of the labor shortages in Canada. And that's the same for the United States as well. So by seeing all this, we see like an economy that is slowing down, not slowing down at a rapid pace, but it is slowing down. And, some people are talking about the fact that we might be headed into the most anticipated recession in history. And that's where we are today. So if we take a look at financial markets, right, we have seen the financial markets being very volatile over the past few months. It's going up and down and up and down, and it has been traded, sideways for the past few weeks, as if financial markets are waiting for an event, a catalyst, either to give us the scenario that everybody dreams of, which is the soft landing, and we get into another cycle of growth, or just push us into the recession that we have been all anticipating.
I had a question for you, Adil. What do you sort of rate the odds of getting a soft landing in over the next year or so? Where do you kind of stand on that whole scenario?
So I don't want to be the bearer of bad news, but it seems to us that it is more likely that we will get a recession rather than a soft landing. So there are a few reasons why we believe that. The first one is if you look at history and you look at different hiking cycle from central banks, there have been only, not even a single time where the bank have hiked rates very rapidly in the pace that they did, in the fashion that they did over the past year, and not pushed the economy into a recession. And that recession is sometimes considered needed by academics and people in central banks, because it kind of cleans up the economy, gets rid of a little bit of deadwood, and then sets up the economy on the right path for a more prolonged and durable and solid cycle. Yeah. So just to go back to because the topic of the soft landing is one that has been pushed by the central banks, and you have to understand the game that the central banks are playing. So they're hiking rates and they're affecting negatively the economy, but at the same time they can't be saying that because everybody's paying attention to what they're saying. So if tomorrow, Jerome Powell or Tiff Macklem came and said we're going to hike rates until we enter into a recession, well, that's not going to go very well with financial markets. So they have to kind of project the desired outcome and hope for, to a certain extent, kind of a not a self-fulfilling prophecy, but that market participants, believe them and act accordingly, and Canadian consumers and American consumers also do the same.
I'll just jump in. Jerome Powell is in charge of the Federal Reserve in the U.S. He controls interest rates, and Tiff Macklem is that version of the Bank of Canada, very much controlling interest rates in our country.
Yeah, I wanted to ask you something. When we build portfolios for clients, we have equities and bonds, and the way we've always explained bonds are kind of that airbag in case there's a bit of an accident in the markets. And last year was an exceptionally difficult year, especially for the bonds, because just when you need them, the airbags didn't deploy. And I wonder if you could just comment a few things about why the bonds did so poorly last year, which is a very rare. And really, more importantly, going forward, will bonds kind of act like bonds again now that we've had all these rate hikes?
Yeah, I really like the metaphor of the airbag. So everybody was waiting for the airbag to deploy and for us to be safe after the kind of crash that we had, but it didn't happen. And one of the reasons it didn't happen is because of the economic environment that we're in, with very high inflation and with central banks kind of trying to control that inflation, and affected negatively both stocks and bonds. But as monetary policy begins to normalize and to go back to something that we knew, and inflation starts coming down, we do expect bonds to kind of behave in their more traditional way. And we believe that what happened over the past year and a half is more an exception than an actual change in the behavior of bonds and stocks.
This is a bit concerning. We saw in this slide, you can see it's U.S. disposable income and their housing prices, 1980 to 2020, and then Canada, our housing prices to our disposable income. Obviously, it's a concern to me. Anecdotally, we're starting to see in the Comox Valley multiple offers again. Very disconcerting for our younger clients going to buy a house, and they have to go with the top offer. And and obviously interest rates went up. So maybe a comment on that. Is that a concern in your office? And then that can relate to a few other banking.
Yeah, absolutely. Let's get a little bit of context as to the two charts. So on the left-hand side, we have the United States, and on the right-hand side, we have Canada. If you look at the behavior of the housing market in the United States and Canada before the 2007 crisis, you will see that they have behaved pretty similarly. They're on an uptrend, be it for disposable income or housing prices. But what happened in the United States in 2007 is we had a housing crisis that did not affect the Canadian market in the same way. So there was kind of a correction in housing prices in the United States, and then they started growing again after a few years. In Canada, if you look at the chart around 2008, you'll see there's a slight dip, but prices start going up again and again. And that can be explained by a few different reasons. First of all, the Canadian lending standards in the 2008 crisis were not as bad as those of the US, where I'm sure you've heard the term. In the US, they had something called ninja loans, which is no income, no job applications. So they were, giving loans to pretty much anybody with a pulse, and sometimes not even that. But in Canada, the lending standards were much tighter. Not only that, but in Canada, what's happening as well is that immigration is a strong driver of economic growth and demographic growth. So as you get more and more immigrants and the actual stock of houses built or the houses that are being built cannot catch up with that immigration wave, well, you start having prices that are going up and up and up. And you're absolutely right that recently, and I can tell you from personal experience, my wife and I were trying to buy our first house. We are looking at higher frequency data. And let me tell you what I mean by that. So you have official housing prices that are published on like a monthly, on a quarterly basis, but we also have data that comes from websites such as Zillow, for example. Or for example, here in Canada, the website that I use is Centris, for example. So Centris kind of gives you the information about the housing market in a specific area. What we're starting to see now, and we did not see in the past, is that prices are revised downwards and houses remain listed for longer periods of time. And so there is clearly a trend that is not being shown in that chart because, of course, it goes only all the way back to 2020 Q4. But if you look at more recent data, you will start to see a correction in the housing prices in the Canadian market in high frequency data, so data that is available almost on a daily basis from the internet, or on more official data that we get from StatCan.
Bill, I have one question. We've got a few calls in from clients about the high-profile bank failures in the U.S. And for some reason, people feel that there's a risk to Canadian banks. We've had a couple calls whether they should take their savings out of their TD Bank or their RBC Bank account, and maybe talk a little bit about how different our banking industry is versus the U.S.
Our banking industry couldn't be more different than that of the U.S. We have a few very strong, big, well-capitalized, solid banks who are adhering to the standards of capital requirements and capital ratios, and they're being stress tested very strongly. What happened in the United States is the banking system is very different. So you do have a few of those big players, the JP Morgans, the Citigroups, and the Bank of Americas, for example, but you have thousands of regional banks that are very, very small, where risk management is very, very poor. Often what people forget to mention is that Silicon Valley Bank did not have a VP of risk management for, I think, close to a year. I mean, they're going to need to fact check that, but it was pretty shocking. And they did not hedge, so they did not protect themselves against one of the bigger risks that they had, which is the interest rate risk. If you look, for example, at JP Morgan, which has much more stringent risk management, measures and following, well, you can see that they hedged that risk, and so the effects of higher rates did not affect them that negatively. And in Canada, we're lucky enough to have a very healthy system, so it's not a major concern at all. I mean, your clients shouldn't be overly concerned about the risk for Canadian banks.
I'll maybe sneak one in, and then we'll go to Rudy to close up. But we sent an email out. I think it was 4,300 banks in the United States to our 33.
Yeah.
So just on the short and long term, without getting too technical, but it is very difficult for banks to make money when we're taking our savings out. We're trying to get 4 or 5%. We need our banks to be we need banks in North America to be profitable. Maybe a comment on that. And it's a tough job for our bank, Bank of Canada and Jerome Powell.
Yeah, it is definitely something it's a complicated issue. Let me put it that way. Usually when interest rates are up and we are hiking rates into strong economic growth, that's an ideal environment for banks. But at the same time, they're being hit by kind of a double whammy. You have those high rates, but economic activity is slowing down. Lending standards have tightened, and they're given less and less credit to consumers or to businesses, small or large. So banks, what they had to do is really focus on the risk management component to get through that period of turbulence in financial markets, and especially when it comes to interest rates. But they are profitable, and they will most likely remain profitable. As I said, the strength and resilience of Canadian banks in particular is definitely not a concern.
I got another question for you, just in regards to kind of the recession scenario. And you mentioned how there's a real labor shortage out there, and usually, jobs aren't that plentiful when you go into a recession, but it seems like that scenario might not be playing out for what comes next. how do you see this whole tight labor market playing into this potential recession?
So there are a few different ways that we like to look at it. The first is like on a long-term basis. So on a long-term basis, you have more and more people that are retiring now. And so there is a demand for workers, but the pool of workers that we can pick from is becoming smaller. And so that kind of tightness in the labor market is there to stay. As population is aging, we're going to have, more and more trouble finding workers. The other more short-term component, and that may feed into the recession scenario that we discussed, is that a lot of firms did something called labor hoarding. So they were hiring more people than they needed because they thought that they actually will struggle to hire them when they need them. So they kept people on payroll they shouldn't have kept. They hired way more. They overstaffed. And one of the industries that is the biggest culprit of the labor hoarding is the tech industry. And you have seen the massive layoffs at Google, Amazon, Microsoft, Meta, tens of thousands of people that have been let go because of that phenomenon of labor hoarding. They realize they might not need all of them. We're going through potentially a downturn. So they kind of, trimming a little bit their workforce.
I can sneak one more in before Rudy closes. And again, timestamp this is, so Montreal, just what's the commercial real estate like in Montreal? I've heard horror stories in San Fran and Amazon closing a store that they opened a year ago. Whole Foods, commercial real estate, the concerns there.
So I'm definitely not an expert in commercial real estate, but the sense that we get is that commercial real estate could be one of the weaker points in the real estate market, and that can affect especially the alternative investment space, which was often considered kind of a safe haven with stable returns over time. I'm talking about private equity, infrastructure, real estate. And we think that commercial real estate might be kind of a pressure point. And we've also seen some defaults from some of the bigger players in the commercial real estate. The business is defaulting on some bonds, so it's showing that the perspective, the outlook isn't that great for that sector.
Good. Well, thank you so much, Dale. Like the perspective you provide really allows us to look things through a very clear filter when we're looking at all the noise out there. It's funny what a difference a year makes. Last year was all about risk, and now we're kind of leading into more risk this year versus in 2021 was all about returns. And risk always comes up in client meetings, discussions with us, and for us, how risky something is how prepared you are for it. And with some of the insights you've given us, a lot of it can be addressed through portfolio design and having managers do the hard work, which is buying when everybody else is selling. And for us, a lot of it comes down to behavior. But doing this for so long, we realized behavior is very, very hard to teach. And we'll be inserting a slide here, but essentially what it kind of profiles for people looking at it is the whole mindset of investing. And there's a lot of news out there telling you to do this or buy this and sell this. And if we can simplify it, and to me, I'm a big fan of simple. If you invested $100,000 25 years ago, and you were jumping in and out of the markets all the time, this chart kind of shows you if you had missed the 30 best market days by being out of the market, your $100,000 would be, guess what, roughly $100,000 after 25 years. The other side of it is if you had just left it and just let the dividends compound and let the investments grow, and you tuned out all the noise and you just stayed invested for the long term. $100,000 25 years ago would be north of $700,000 today. So that's really the message, is to say, keep things simple, and the more you can tune out a lot of the noise, that's the bigger job, the fear and the greed, managing the behavior. I'll close with a quote from Dwight Eisenhower. He talked about military genius, and I'll parlay that into investment genius, where he said, all that is really genius is all about doing very average things when everybody else is losing their minds. And I guess he was talking about the battlefield, but that applies to investing as well. As we always say here at Mindset Wealth, your mindset affects your behavior, and your behavior affects your results. Thank you very much, Adil, and thank you everyone else for listening in today.
Thank you.
Thank you.